What's up, everybody? Happy Friday to you. This is the David Green Show. I'm David Green. We're getting into real estate and economic news today, kind of trying to figure out what's going on with this weird market. Feels like we might be sliding into a recession. Feels like we might be sliding into housing prices coming down. Also feels like at any minute this thing could turn around. It's kind of weird. There's a lot of tension from each side. So I'm covering the news every day that I can and bringing you guys updates on what's going on. So let's get into what I have for you today. This first article comes right out of California. If you don't know, I lived in California my entire life. I recently moved, but it's pretty much the only market I've ever known. This comes out of realtor.com, says California home prices may drop soon as housing market flashes warning, a real estate CEO says. The housing market in California is flashing a key warning signal that could lead to a slowdown in home price growth or even falling prices in some markets. The supply of homes for sale in California is surging, rising 44% in February compared with a year ago. The national increase was 28%. So more people are putting their houses for sale in California than the rest of the country. And if you live in the rest of the country, this probably comes as no shock to you. But if you're in California in the little bubble, you might be thinking that that's surprising. The California surge is the fourth largest annual increase in active listings among the states, behind only Nevada, Hawaii, and Colorado. In some California cities, the effect is even more pronounced. Nick Gurley, the founder and CEO of real estate data startup Reventure, noted in a recent post on X that 5 of the top 11 U.S. cities for annual inventory growth are California, which includes San Diego, where active listings are up 61% from a year ago. Rising inventory is usually an early warning sign of weaker price growth as supply begins to outpace demand, leaving buyers with more options and forcing sellers to make concessions. It's very realistic to expect that based on the more than 50% year-over-year inventory increase in some of these markets, we're going to see a big slowing in home price growth over the next 12 months. I wouldn't be surprised if prices trend flat across the state or even slightly negative by the end of the year, particularly in certain markets, he adds. Some California markets might also have hit an affordability wall on home prices. In San Diego, for example, the median February price of more than $948,000 is far out of reach for a family making the local median household income of about $104,000. Still, Gurley says the rising inventory warning comes with an important caveat, which is that California's housing supply is expanding from a state of severe shortage. And today, just 0.6% of the state's homes are on the market. So it's less than 1%. It's a little over half of 1%. Statewide housing inventory remains well below pre-pandemic levels, and Gurley doesn't anticipate a dramatic price correction in California, but rather a more gradual market reset supported by low unemployment and mortgage default rates in the state. We're still nowhere near what we've seen in Florida in terms of supply, he says. I almost view that what we're seeing in California today as maybe what we started seeing in Florida a year ago. All right, so California housing market is not doing amazing, but it's not crashing right now. It just kind of shows that people are hesitant to buy there. If you're wondering why, part of it is probably the political environment. That's obvious. Part of it is the insurance problem that they're having over there, with insurance companies being forced out of the state because the state legislator won't let them raise the prices that they're charging to people. Part of it is just the cost of living. They tax so much in California, so much. Like I'm in the Midwest right now, and gas is about $2.65, $2.70 a gallon. In California, it was like $5.50 a gallon, and it could get up in the sixes sometimes. Everything is expensive. The minimum wage is $20. So you try to buy anything cheap, the people selling it all have to get paid. And it's an example of what happens when you spread the wealth too far. So there's people making money in California, but then people move to California that don't work. I get angry comments every time I say this. It's just a fact. Go there. You'll see for yourself. The people that don't work still need to eat. They still need healthcare. They still need somebody to help keep them alive, and they have a vote. And so politicians can cater to the people that have the voting power by giving them things, and they give them things not of their own wallet. They go take it from the person that did work through taxes and redistribute it to the people that they say it's not fair for. And you get this problem where everything becomes expensive. That's basically what's going on in California now. There's a reason people live there. It's amazing in so many ways. If you're an outdoor person, I can't think of a better place to be. You can snowboard in the morning and be on the beach by the afternoon, literally. You've got amazing big cities, amazing culture, incredible food, really nice weather. You've got deserts, you've got mountains, you've got hiking, you've got beaches, you've got small towns, you've got big cities, you've got agriculture. I don't think there's a state in the country that has as much of everything like California does. It just has its issues because of the people that move there and the way that the voting base works. So I think realtor.com pretty much got that one accurate about the issues with living in California. Now, I sell houses in California. I am still a real estate broker and I sell homes. So if you've got a house in California that you're thinking about selling, if you have the desire to buy a house in California, I'd like for you to reach out to me. Head over to my website, davidgreen24.com. Look for the chat option. You can get a hold of me there or send me a DM on Instagram at davidgreen24. And if you're a real estate agent in California, I'm building up a team. So I'm going to be starting a brokerage. I'd love for you to hang your license with it if you're the right fit. So reach out to me about that. And then also keep an eye out on the David Green Show for the Real Talk Realtor podcast that is content made specifically for real estate agents. All right, our next article here. What to expect for the rest of the year in the housing market. I thought this one was a pretty good one. Most likely, mortgage rates will stay above 6% and home prices will climb moderately. But that shouldn't dissuade buyers who are ready to make a move. This comes from Kiplinger. In some ways, now is a challenging time to take the plunge and buy your dream home. Many homeowners who are locked in ultra-low mortgage rates a few years ago continue to stay put, limiting the supply of homes for sale. And it remains to be seen how the new presidential administration's policy decisions will affect the housing market. But the general consensus among some of the country's most respected housing economists is this: if you need to buy, then buy. And if you decide to buy, make an informed decision. Trying to time the housing market is a fool's errand. The right time to move is the right time to move for you, as long as you can find a place that meets your budget and fulfills your needs. Others opt to move to improve their lifestyle, to be closer to work, for example, or to have a backyard for the kids to play in. So this article sort of goes on, looks like they want me to subscribe to their thing, which I'm not going to do for one article. This goes on to describe how a lot of people treat stocks or the housing market like the stock market. And I agree. And I agree because I get so many people that reach out to me with a very similar question. Like, what's the right time to buy? What's the right time to buy? I'm waiting for the dip. That is terminology that we get from the stock market. When everybody else is out, you want to get in. People are trying to time it. And it's just so hard to make real estate work that way. And even if you're somehow able to do it somewhat successfully, you have so many other variables in real estate investing that you don't have in stock market investing that it becomes much less impactful on your overall investment. So you could buy a house and not time the market, but get a good house and do great. You could time the market perfectly. And just by luck of the draw, something starts breaking in the house. Plumbing starts leaking. Tree roots grow into your sewer lateral pipe. Your roof goes out when you weren't expecting it. Your neighbor wants you to replace a fence. Like, there's so many things that can come up when you get into real estate investing that trying to time the overall market does become a fool's errand. It's much better to get to know the asset class that you're investing in and then make decisions for the long run, not the short run. The short run is all about timing the market, dollar cost averaging, day trading. You're always paying attention to what's going on and just overloading your brain with data. Real estate investing, in my opinion, really works better for people that make solid choices, plant that tree, and then go on to make their income in other areas, and then just keep investing the money that they made into real estate as opposed to trying to use real estate to make their money. Next article. U.S. faces risk of default in August if the debt limit isn't raised. This is scary. The nonpartisan Congressional Budget Office on Wednesday released a projection that the U.S. government will need to raise the debt limit again before this fall to avoid a potential default on the nation's obligations. What this means in layman's terms is the credit card company has set a limit on how much you can borrow, but you don't have enough money to make your debt payment. So they have to let you borrow more to pay back the money that you already owe. In normal cases, no one lets you do that. You just go to default and they go take your assets. But in this case, because we're the country that prints the money, we can just keep raising our own credit limit. And by we, that doesn't mean someone else. That means you. You're part of it. If you're making income and you're paying taxes, this is your money that they're talking about spending. The CBO noted that if the government has to borrow significantly more than expected, the extraordinary measures could be tapped out in late May or in June before tax payments due in mid-June are received, or additional measures become available on June 30th. If borrowing is less than expected, the exhaustion of extraordinary measures could be later than August or September. If the debt limit was not raised or suspended, the Treasury would not be authorized to issue additional debt other than to replace maturing or redeem securities. The CBO wrote regarding that would happen once extraordinary measures are tapped out. This restriction would ultimately lead to delayed payments for some activities, default on all its obligations, or both. Those actions could result in distress in credit markets, disruptions in economic activity, and rapid increases in borrowing rates for the Treasury. The uncertainty surrounding the timing of when the X date for the exhaustion of extraordinary measures comes as lawmakers in Congress are not only dealing with the annual spending bills, but also Republicans' push to extend the 2017 tax cuts through the reconciliation process. This should rise to the top of the priority list because it is the one item that could potentially have the biggest impact on the economy if an extension of the debt limit is not extended in time. I expect and hope that policymakers are squarely focused on this as we go through the coming weeks, in addition to all the other important items that are on their agenda. So what this means is we're going to have to extend the debt limit, sell more debt to the American people or other countries through treasury bonds, raise money that way to pay the bills that we have because we don't make enough money at our jobs, which for the government, their income is basically what comes in through the IRS for the most part. And our expenses are all the social programs and the budgets that we have for things like the military, like the education department, all that stuff. We don't bring in enough money as income to cover all of our expenses, but those expenses are very popular with the people that are used to getting them. So when a politician comes in and says, I'm going to cut all of these expenses, we vote for the other one that doesn't say that. And what that means is we keep voting in people that keep giving us free stuff. Well, it's not free. Other people pay for it. And that raises how much we owe. And then the people that are working have a higher and harder burden to pay that money back that is owed. And then we try to increase taxes on them, and then they want to work less. This is sort of the economic cycle that the US government is in. If you were in this in your own position in life, people wouldn't let you keep borrowing money. You'd have to declare bankruptcy. You'd have to go into default. You'd lose some of your assets. Your credit would be affected. And you'd have to start over and just try to take a different approach where you spend less than what you make, right? I feel like this problem happens when we are doing really good as an economy. We're in a market where everybody is making more money and therefore they spend more money. If you just think about real estate investing, which is why most of you are listening to this, because you like that. We want to buy assets when we feel rich. When we feel like we have a lot of extra money, we say, what can I do to make it grow? So we go buy real estate. Well, do you want to buy real estate when you feel poor? When you feel like you don't have enough money to pay your bills, you don't have enough money to get groceries, nobody wants to buy real estate. What happens when the rent stops going up because your tenants can't afford it anymore? Or when the expenses for your property keep going up? No one wants to buy real estate. You're not looking at an appreciating asset to set you up for retirement. You're looking at a freaking blood-sucking, not even asset, liability that keeps sucking money out of your pocket. And the more real estate you have, the more money you're losing. A lot of people are in that boat. And I think this relates to why we're seeing the housing market stall in California, which is the wealthiest state in the country. And so when everyone's making money there, the home prices are going up. Now that people are not doing as well, home prices are getting stagnant and may even go down. The only way you fix this, the only way, is you increase the country's income and decrease its expenses. I think that the government is trying to decrease expenses with Doge, the plan to go through and eliminate waste. And they are trying to increase income in two ways. They're trying to put people back to work, and they're trying to create income from other countries to get them to pay us something. If you weren't aware, the US government directly supports a lot of other countries, and it indirectly supports a lot of other countries by offering them protection. So, for example, a country like Canada, a country like London, a country like Israel, they don't have enough money to create a military that could protect their own country from whatever the bad guy of the day happens to be. So the US says, hey, we got your back, don't worry. Well, it may look like they don't have to, they're not saving money, or may look like we're not spending money is what I'm trying to say, but we are. We are spending the money on our military budget to be big enough to not only protect us, but protect all these other countries, which allows them to not have to spend that money on their military. Well, if they don't have to spend it on their military, they're able to spend it on their healthcare system, their educational system, the public opportunities that they offer to their citizens. They have more money to put to that because they have Big Brother over here that will step in and kick anyone's butt that messes with them. And so now we're kind of looking at, well, how can we get some money back from them to compensate us for the money that we have spent protecting them? It's very similar to if you've heard about the mineral rights in Ukraine situation. The U.S. spent a lot of money giving dollars to Ukraine to fight the Russians. And they're saying, hey, we want mineral rights when this is all said and done to pay us back for the money that we spent. It's just become normal for the U.S. to give other countries financial support and them to give us goods and services. And our current administration feels like it's not equitable. We're not getting back as much as we give out. So they're looking to try to get more back from these other countries. They're also looking to try to manufacture more things in the U.S. and sell it to the other countries. Now, that's hard to do because those countries put tariffs on us. They charge us money to sell our products over there. And so the current administration is saying, hey, if you're going to do that, we're going to do it too, which is where a lot of the tariff talk comes from. But if they don't work out, it just makes everything more expensive when we already had inflation and it's bad. If they do work out, it creates revenue coming in for the U.S., which we desperately need through the tariffs. It also creates an incentive for Americans to make more stuff in America, which gives us jobs, which gives us people that are making income, which means less people are draining the government for that stuff, and more people are paying into the government through income taxes. So you're sort of winning in several ways there. At least that's my understanding of what our financial strategy is when it comes to the tariffs that are being talked about and how that relates to the real estate market. It hit me today. I've got several houses up for sale. No one's buying them. And somebody messaged me and they're like, hey, where are you buying right now? And I was like, yeah, I'm not buying. Bing. Little light bulb went off in my head. I'm not buying because I don't have a lot of money coming in. My businesses are based on real estate transactions. I have a mortgage company. I have a real estate team. I have a property management company. I teach people how to invest in real estate. I'm just a real estate guy, right? So when everyone's buying real estate, everybody needs my services. And I help them to make money and I make money. Well, when people aren't buying real estate as often, they don't need my services. So I don't have money coming in. I don't feel wealthy. I don't want to go buy a bunch of real estate when I don't feel like I'm rich. In fact, in a lot of ways, when you're losing money, you're trying to sell the real estate that you have. And then when you're put on the market, so are all the other people that are not feeling wealthy. And that's what relates to the first article that we just read. So I hope that kind of helps you see how the puzzle pieces are getting put together. And that the only way that we get the housing market strong and we get the economy strong is we get people in America producing something of value. And through that, the government's going to collect revenue from the work they do. And then we can kind of balance this problem that we're having in order to not have to keep raising the debt ceiling over and over and over because we're not being productive. We're not making enough money as a country, not just as the individuals. All right. This article from CNN says that consumers are saving more and spending less on Trump's tariffs as Trump's tariffs loom. I don't know if this is actually about his tariffs. I think that a lot of the media that we read is very biased and they're going to spin it to look that way. I think people have been spending less and saving more long before the tariff talk. I don't think people started this like a couple days ago when this came out. As tariffs are looming, inflation is still sticky and U.S. consumers are bracing themselves for the impact. According to data released Friday from the Commerce Department, Americans socked away money into savings, pulled back on discretionary purchases, and when accounting for inflation, increased their spending ever so slightly after taking a breather in a frigid and post-holiday January. At the same time, inflation data showed minimal progress on the easing of price hikes. But the most comprehensive economic data to date on how prices are changing and how consumers are earning, spending and saving doesn't fully account for the elephant in the room: Donald Trump's aggressive trade policy. Recently imposed tariffs on auto imports and a slew of other levies waiting in the wings stand to weigh on consumer spending, America's economic engine, and drive prices higher, economists warn. There is no other conclusion possible other than the Trump's 2.0 economic policies are frightening consumers as much as they do corporations, says the chief economist at FWD Bonds. The economy is going to stall out, if not something worse, if Washington policymakers are not careful. The personal consumption expenditures price index rose 2.5% in February from the year before. On a monthly basis, prices rose 0.3% unchanged from January. Economists expected that falling energy prices and stabilizing food prices would help keep the disinflationary trend at hand, and that was indeed the case. Forecast called for the PCE price index to be unchanged from January's January's preliminary 2.5% rate. However, one critical barometer, the core PCE index, which serves as a gauge of underlying inflation, came in slightly hotter than the economists expected. The Fed last week kept interest rates unchanged, and Chair Jerome Powell indicated that central bankers are waiting for more evidence that inflation is headed toward their 2% target or that the economy is weakening before they return to cutting rates. Powell acknowledged that it remains unseen how uncertainty swelling around Trump's aggressive economic agenda affects future spending and investment. Excluding the effects of inflation, consumer spending rebounded in February, rising 0.4% for the month. In January, spending was weaker than the initial reports and fell by 0.3%. Where consumers put the dollars was especially telling. They shelled out more for goods, likely reflecting the pull forward of buying products before tariffs hit, economists say, while pulling back sharply on services spending, such as eating out and traveling. Heightened uncertainty around the economic outlook, fears of accelerating inflation, and the declines in the equity market are depressing consumer confidence. And now we see signs that the soft survey data are starting to weigh on the hard economic data. However, when adjusting for inflation, spending in February was up a mere 0.1%. So it doesn't look like inflation is the bad guy like it has been for a long time. It looks like consumer confidence is where we have the problem. People are nervous and they're worried. There's a lot of uncertainty and they're not moving. My personal opinion that I'll just slip into this video is that we need to get back to wanting to be productive. We need to get back to people wanting to work. We need to get back to people wanting to do things and make things and not always looking for the easy road, which becomes really easy to get sucked into when you have 10 years of economic growth and that becomes normal, right? And I think that's why a lot of people are mad about Doge. They're going to get exposed that they're not working really hard. And that can be a good thing in your personal life when you realize that, hey, there's another level for you to get to and it leads to personal growth. But it can be a bad thing if you become obsessed with bitterness, which is a great point. If you're someone who's struggling with bitterness, struggling with fear, or if you're just having your eyes opened to the economic system that we live in right now is not a guarantee that you're going to be safe and the government can't keep you safe. It's really your responsibility. And that's a little scary. I've got some good news for you. I'm starting a faith-based group called Spartan League where we will talk about life, spiritual matters, things that really you should be thinking about in life and what you might be doing that's sabotaging yourself to hold you back from having more success. If you're interested in that, all you got to do is go to my Instagram, DavidGreen24, and send me the message faith, and you'll get a link to sign up for a free webinar that I'll be putting together. Appreciate you guys. Hope that everybody is doing well. I'm going to read a couple comments, and I'll get you out of here. Buy, Fix, Rent, and Repeat says, hi, David. I'm glad to see you're doing your own podcast and you can say what it is you feel or think now. Thank you for that. From your own opinion, you think California housing properties might go down in correction value? Are you still buying in California? And when are you buying? I'm selling a couple of California properties right now. So no, I'm not buying in California at this moment. Doesn't mean that I think that you can't do well in California. I still think it's the state that more people want to live in than anywhere else. Kennedy Collado says, that's why we are Empire State. If we step off, China and Russia will take over. Live Life Restored says, woo-hoo. Hope we get a message that says faith from Live Life Restored there. And Whitney Shea, question for you, Dave. We are an active duty family about to retire after 30 years of service. We own single family homes in Florida and South Carolina that are paid off. When we last changed duty stations from Eastern Europe here in the Tucson, Arizona area, we purchased a home, a new build at exactly the wrong time with interest rates. Our monthly interest payments on this home makes me sick to my stomach, as I believe it's around $4,000. My question is since, and then a cliffhanger. We didn't get the rest of it there, Miss Whitney, and I'm looking to see, and she might be typing it right now, but it's not coming in. So you're going to have to send that in the next time we go live, and we'll answer your question there since we didn't get all of it. Appreciate you guys. Thanks for being here. I got to jump and head into a meeting, but make sure you subscribe to the channel and share this with other people, as I'll be doing these little quick economic updates for you every day that I can to talk about what's going on in the news, how it affects you, and what the right play is to keep your money safe. Thanks, everyone.